Hello, everybody, and welcome to today's stock market jobber technical analysis lesson. Now, I hold the CMT, which is the Charter Market Technicians designation, and I've been a long-standing member of the Market Technicians Association. And here's the thing: 98% of the technical analysis education stuff that you see is in the past, right? It's like, oh, here was an example of this, or here was an example of that. And of course, these analysts don't want to point out the bad calls they made. So what I decided to do is to do a class pretty much every day, at least during the week, 5 days a week, where we look at real-time charts and see what's going on. And every chart can teach us some stuff. So let's just jump right into this here. So this is our Spider Communication Services ETF. The symbol is XLC. This tracks the communication services sector. This is the home of Google and Facebook. And we can see some interesting things here that are common principles in financial markets. We can see these things I'm going to point out on pretty much almost any chart. So here we have a level that was support, right? The market's going lower. There's not enough demand or buyers to take in all the shares that are being sold. So the sellers are forced to offer out their shares at a discount, and this forces a downtrend. Now, when we get to support, well, the tide turns, and there is enough demand. Now, a lot of times when we get to a support level or a resistance level, we tend to make a move. This is because the investors who created the support with their buy orders start to get the sense that there are other buyers around. That's why the price isn't going lower anymore. And they decide that they got to pay a little bit of higher prices because they don't want to get cut in line, so to speak. If you're willing to pay $52.50, but someone else is willing to pay $53, well, the sellers are going to go to the person who was willing to pay $53. So it becomes a snowballing effect. So now we get up here, and this is resistance, and this is the opposite. There's not enough supply when the market's moving higher to fill all the demand, but when we get to a resistance level, there is. And now the same thing happens as happened down here, but it's just the opposite. The sellers start to get worried that they're not going to be able to sell their shares because there's other sellers around. That's why the price stopped moving higher. So they decide to reduce the prices that they want to sell at, and it becomes a snowballing effect on the downside. Now, here we see the level that was support turns into resistance. How could this happen? Well, this happens because of buyer's remorse. There are people who bought over here who regret doing so when the price goes lower, and they tell themselves, I made a mistake, I want to get out, but I don't want to lose any money. So if it gets back up to my price, I'm going to sell it. So if we have enough remorseful buyers placing sell orders, the level that was support can turn into resistance. Here we have the opposite. Resistance turns into support. This is because of seller's remorse. People sell, and when the price goes higher, they regret doing so, and a lot of them tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders, the level that was resistant can turn into support. So buyer's remorse turns support into resistance. Seller's remorse turns resistance into support. Here is a basic principle of financial markets. This down here is what we call the relative strength momentum index. It measures momentum, and momentum is how far something has moved in a given period of time. If most of the time a security or a market is going to be within its typical or historical range, but if we get above that, we call that overbought. That's kind of important because it attracts sellers into the market. So this is the principle. Overbought markets that get to resistance tend to sell off. So how can you use this? Well, say you're thinking about selling something and it's trending higher and you don't know where you want to sell it. Well, if you see it approaching a level that was resistance before, there's a good chance there's going to be resistance there again. And if it's overbought, that's probably a logical time to sell it. So as you can see here, resistance can remain resistance. Resistance can remain resistance. And this is also due to psychology. There are people who bought up here who regret doing so, and they tell themselves, gee, if I can get out at break even, I'm going to. So this, when the price comes back, we got sellers who are buyers back here selling here. Now, we can also see here, there's an old saying that gaps refill. This is a gap. When something closes at one price level and opens at a much different price level and there's no trading in between. Well, we know one of the reasons why there's support is because we have remorseful sellers placing buy orders. Well, if something never trades in these levels, there just can't be anyone who sold it. So you're not going to have these remorseful sellers placing buy orders. So there's not enough buy orders around, so the sellers are forced to push the price lower. And notice how it refills real quick here. This 3 big moves in a row. So that is a gap refilling. This is a common Wall Street expression. We can also see it on the other side. When things gap down, when things get gapped down, if they go lower and then turn around and come back to the price levels that gap was, they tend to make a quick move through it. Now, why is that? Well, because if it didn't trade in a certain place, you're not going to have remorseful buyers who are trying to sell. So we can see a couple of examples here. We gap down here, and then we got this rapid move up right through it, right back through the gap. Because remember, there were no one buying in there, so there's no one who is going to be remorseful who's trying to sell. So there's going to be less sell orders than if there usually was. And you can see this a lot of different places. It's kind of this, it's not technically a gap, but it's the same principle. When we move really fast through a couple levels, through price levels, well, there's not a lot of time for a big amount of vested interest to form. So you're just not going to have a lot of buyers trying to get out at break even because it traded through those levels so quickly. There just isn't a lot of time for there to be a lot of buyers. We can see here a gap down here, and then we fast move up through the gap here. So we can see these principles on a lot of different charts. All right, everybody, that's it for today. Thank you so much. Please make sure you subscribe to our YouTube channel, and please make sure you check back with us because I'm going to be putting out a technical analysis lesson pretty much every day, and I hope to see you soon. Thank you.